The next strategy that we're going to go through, it is the short put option, okay? The payoff diagram is pretty much the reverse of the long put, because remember, on the long put, we have something like this, which our maximum gain, which is if the stock goes to zero, maximum loss was the premium that we paid. In this case here, our maximum gain for the short put, it is the premium that we're going to collect here initially, okay, to open this trade. And of course, our maximum loss is if the stock goes to zero, okay, because if the stock goes to zero, we're gonna have to buy this thing here for whatever strike price that we sold and sell for zero. Because if your strike price it is 100, you're gonna have to buy for 100 and sell to zero. So pretty much lost the whole thing. So this is the maximum loss of a short put option. Our maximum gain, it's gonna be the premium received. The maximum gains, in other words, or the maximum P&L of an option seller, it's always equals to the premium received to open the trade. Now going through a simple example. So in this case here, we're going to sell an option with a strike price of $100 and we're going to collect $5 per share. One thing here that's very important for you guys to understand is that if we do get assigned in one contract, in one short put, okay, remember, this will be equals to 100 shares. So if we have to buy 100 shares times the strike price, which in this case it is $100, we need to have at least 10K in our account to cover the cost of assignment. Another video for there, plenty of things on my channel. You guys can learn how to get unassigned if you get assigned, okay, and move on with your trades, all those good stuff. So go and watch. You got plenty of videos in our channel. I just put this thing here so you guys can have an idea what I'm talking about, because it's very crucial that you guys do understand what means assignment and how you can unassign yourself when you get assigned on short put options, okay? So let's say, for example, after a short period of time, the premium has dropped 80% and now it's worth $1. So basically went from $5, time decay worked for us and it's worth $1. Why now? What you can do is we can close the trade because we already captured here $400. In other words, 8%. So our profit right now, it is $400 because we need to multiply the 4 that we made out of 5 times 100. So if we have to pay here $10,000 to buy the shares and we made $400, how much have we made? 4%. This is our rate on capital. But don't forget, doing the rate on capital here on the money required for cash secure put. But if you use margin like I do, for example, margin in this case here, guys, will be roughly 20%. So this trade will require me to have roughly $2,000 as a buying power. Okay, so this is like what, a 5-to-1. So this return here will be roughly 20%. Okay, so you guys can have an idea, because this here will be like what, $2,000. This is a cash account. I'm not even talking about here margin, so you guys can have an idea how powerful this thing can be. And of course, our annualized rate of return, you need to calculate in this case, because we were in the trade for like roughly 30 days, it is 48%. Guys, I know, I understand, I'm making very easy here doing the calculation bi-weekly, bi-monthly, but you can do your 0.04 times 365, okay, divide by 1 month, let's say 30 days. Okay, we'll give you a little bit more, probably 48 something, I don't know. Do something like that. Let me do a calculation here. On the calculator so you guys can have an idea. So 0.04 times 365 divide by 30 times 100. Okay, you need to multiply this thing here times 100. So you can have your annualized rate of return. This is our days in the trade. Don't forget. And this is our 4% rate on return, rate on capital, whatever you want to call it. So in this case, if we use the different formula, it's 48.7. I just want to make things easy here so you guys can understand. You can use both ways. It doesn't matter, okay? So you guys can have an idea. So in this case here, we're getting 48%. Let's say when you open the trade, we're supposed to get 60% annualized, right? But if we can close this trade here at 80%, okay, I already realized, because we can close now and realize this game. Now it's unrealized because we haven't closed the trade. But if we close this trade here and capture those $4, will be a realized game. So why not realize $4 out of 5, which is 8%, and lock here on 48 instead of 60? If we had, let's say, for example, another 2 weeks in this trade, it doesn't make sense. Why are you gonna leave a trade open for another 2 weeks to capture another 20%? Okay, especially if you, in this case, where you're selling option, gamma can get massive high in the very short duration options. Anything can happen in 2 weeks. You might have earnings, you might have some news. Guys, it's just not worth. Okay, you have captured 80%. Is a lot when it comes to selling option. Of course, there are some other case scenarios, like for example, if I'm trading futures, EMS or ES, whatever, if I'm down here 30% with my short put, I'm gonna wait to get a sign. Why? Because I want to get a sign and I want to hold this thing here for the long term, if you guys get what I mean. Okay, why? Because if I get a sign on 30%, 40%, thank you very much. But if we go back here, for example, okay, on trading view, if you get a sign here at 10%, guys, doesn't make sense. So if you're trading here is already 80% on the green, okay? If you can capture 80% from the all-time high and you put here is only 10% out of the money, guys, thank you very much. See you later, alligator. I'm out of this trade as soon as possible, okay? As soon as possible. So it's all about where the product is trading. Because if you put, like I said, is only 5-10% from the all-time highs, if you get a sign, no good. But if your put is down here 30%, guys, thank you very much. You're going to hold this thing here for the long term. That's why it's very crucial for you to trade. Let's say, for example, futures or indexes or ETFs. Because if you get a sign here 30%, long term, guys, would be a great place to get in because you can still sell your cash secure puts here. You can still lower your base cost. But from 30, you can go to 40%. How much more discount price do you want to hold the index, ETFs, or futures at 30+%? I can buy all day long. Okay, very, very crucial to understand, because these things, which it is what make anyone a profitable option trader, especially when it comes to sell options. Okay.